Empty malls and no diners at restaurants. For many businesses, it's a throwback to the circuit breaker of 2020. But having gone through that period, F&B players like Tenderfresh are now pivoting to their circuit breaker playbook for survival strategies.
We actually quite anticipate the new tightened COVID measures to kick in. When the numbers of community case is growing, the staff are more ready to switch to the delivery mode now. Because of the past year's experience, this year we are more well-versed.
Still, Tenderfresh is adjusting operating hours and putting some staff on leave to keep costs down. It's also banking on its central kitchen and online bento box offerings to make up for lost sales.
So we are launching bento boxes, we're launching snacks. Last year we did quite well. So we bring it forward this year and then we just do it again.
Tenderfresh has 74 outlets and 18 F&B brands island-wide. Last year, its restaurants saw a 30% drop in revenue during the circuit breaker. But its coffee shops and kiosks fared well, managing even to launch a new coffee concept during the pandemic.
For the food kiosk and coffee shop division, we do experience a pickup since the phase 2. But for a restaurant within the mall, it's a bit more affected because of the strict social distancing. So we actually took out 40 to 50% of our seating capacity.
In the past months, Singapore's retail sales have been on a recovery path, rising 6.2% in March, with discretionary industries seeing the biggest gains. F&B sales were also on the mend as restaurants and other dining places saw upticks compared to the year before.
The recovery has been pretty decent. There was some pent-up demand at one level and a sort of a reallocation of vacation dollars towards pampering ourselves and buying those things which we might have delayed last year.
The retail sector was one of the worst affected during last year's circuit breaker, with the heightened alert calling for stricter rules on social gathering, no dining in, and work from home as a default. The sector will likely take another hit.
Majority of the businesses are down. The minimum down is 50% and the maximum is more than 90%. Operational costs such as the manpower and the rental are the biggest concern for retailers during these times.
So far, F&B players are getting government support for wages and online deliveries. But the Singapore Retailers Association says other businesses need to help as well.
They should have given some 50% JSS. Now the situation is very critical. Maybe big companies may have big reserves, they can continue for some more time. But small retailers have almost exhausted their reserves, their money, their resources, and they may lose hope.
Several mall operators have rolled out operational support and rental rebates for tenants.
It's very difficult unless they are getting some support from the landlord in terms of rental rebate according to the sales or gross turnover basis rent. You achieved 50% sales, therefore you pay 50% of the rent committed. If it is 70% down, they should also give rebate of 70%.
For real estate investment trusts that include malls in their portfolio, F&B tenants make up 10 to 40% of gross rental income. Analysts say the tighter restrictions could affect some REITs' near-term outlook.
We would look at buy on weakness. The names that we like in the retail would be MCT and FCT. So when there is a hope of recovery, hope of reopening, I think people will start to actually look at the central malls again, like land lease.
The tighter COVID-19 measures have also weighed down stocks in the transport space. Market watchers say investors will be well placed by focusing on defensive plays.
Raffles Medical, as well as T&M Dental, that involved in the testing value chain. Names that are more diversified, like ST Engineering and Wilmar. There are also companies that benefit from a structural point of view, like KDC REIT, because of demand for data increase in the medium term. SGX is also a potential beneficiary because the liquidity in the market is still very strong.
For RHB Bank Singapore, glove makers, protective wear manufacturers, and some consumer plays will be the clear standouts.
We think Sheng Siong and Kimley would be the key beneficiaries. We recently upgraded Sheng Siong to a trading buy with a higher target price of about $1.95.
Despite the near-term weakness, RHB Bank Singapore remains confident on economic recovery.
Although uneven, we do believe once we get past the speed bump, the economic recovery story should sustain. We are still sticking to our balanced investment strategy recommendation, which offers a healthy mix of cyclical names which have structural growth drivers behind them, and also balancing it out with high dividend and earnings growth companies to protect for the downside.
Across sectors, RHB's top picks include OCBC and DBS for banks and Riverstone and Raffles Medical for healthcare. It favors ST Engineering for industrials, Ara Logos and Ames APAC REIT in the REIT space, and Comfort Delgro, China Aviation as transport plays. Fuyu and Franken are its top tech picks. As vaccinations continue to roll out and government support provide a cushion, some say the impact of the tightened COVID-19 restrictions should be temporary.
The businesses are a lot more adept now. They know what their strategies, to some extent. The current restrictions will be more of a speed bump rather than a circuit breaker. But that said, we do depend a lot on tourism for a lot of retail sales. Until we get the complete tourist traffic coming back, it will be sort of a tough going for the retailers.